Drop it.
Hello and welcome to Be Real, the Maryland real estate podcast. I'm Brad Cox with the Vesta Group of Long & Foster, and sitting across from me...
I'm Michael Becker of Sierra Pacific Mortgage. Good to be back, Brad. It's we're recording this a little later than we normally do. I had to go to the beach house and meet some delivery people, and actually met with a contractor to do. I've decided I don't think I'm going to do the bathrooms myself. We've
good.
A friend down there recommended a handyman. I'll buy the stuff and he's going to install it.
Okay.
I think I could have done it, but I think it's well worth when you figure out the time and the frustration factor.
Yeah, well, and this is not meant to be an insult. You're pretty anal, so it's going to come out looking good.
A lot. It'll come out looking better, right than I did. I would have probably started and not liked it and tore up I'm just going to just doing new flooring.
Yeah.
Replacing the toilets and vanities. Not a major rehab, but just trying to update the bathroom.
Yeah, that's great.
Nicer.
That's great. So. Okay. Well, Michael, so we had some really good sports news going on.
It's been a good week for Maryland and Baltimore sports fans.
Yeah, it really has. So
started
Lamar,
last Thursday.
Yeah, we got Lamar, 5-year extension.
It's exciting. It was great. I'm surprised it didn't happen sooner, but I think maybe because he didn't have an agent. But he is the highest paid player in the NFL now. I think that's based on an annual thing.
Yeah.
Because the total of Patrick Mahomes' contract was greater, but his was 10 versus 5.
Right.
He got a lot of it guaranteed, the most guaranteed of anybody for 5 years, I think. So he should be happy. And not only should he be happy about the size of his contract and the amount of guaranteed money,
but some of the weapons that he's been given.
What the Ravens did to give him more weapons. I mean, we added Odell Beckham Jr. Now some say he's injured, he's 30, blah blah blah. He's still. Remember how great Steve Smith was in his mid to late 30s?
Yeah, sure.
And speaking of Steve Smith, the guy Kid Flowers from Boston College.
Yeah.
A lot of people are comparing him to Steve Smith, and that was our number 1 draft pick.
Yeah.
Very excited. Steve Smith loves him, so. That's all. I would say that's a good sign. So we will see if Lamar.
He's got to deliver now.
Can become a better passer.
Yeah. He's got to deliver.
Sometimes he's very accurate. Other times I've seen him overthrow wide open receivers downfield, and that's very, very.
He also needs to last the entire season.
That too, but maybe running the ball a little bit less.
Yeah.
Although both times he got injured were like kind of weird accidents. It's like somebody tackled him from behind. He just hit the ground weird and messed his knee up last year, and the year before I can't remember, but it wasn't the normal running play that he does that injured him.
Right. So we're going to pray for that, and then the Orioles are just cranking it out.
It is great to be an Oriole fan. It's 20-9.
Unbelievable. Second place in their.
Not only
division.
They in second place in division, if they were in any other division at this point, they're 20-9.
Right.
They would be leading every other division in baseball. But Tampa Bay's insane to start the year.
Yeah.
They are beating up on lesser competition.
Yes. And the other great news is that we're ahead of the Yankees.
That's all you care about, right?
It is, pretty much. It's always nice to be ahead of the Yankees. Well, and also, Shep. We're ahead of the Red Sox. That's my good friend Shep. He's a huge Boston fan.
Well, Red Sox were in the cellar. They've moved ahead of the Yankees as of now. Every team in the AL East has got a winning record, which shows you how tough. Although I don't think did they get this year. We'll have to look into this. I think they got away from the unbalanced schedule where you would play like 19 or 20 games against those in your division and less amongst others.
Yeah, I'm not sure.
Doesn't seem as I scroll through it doesn't seem like we're going to play the Yankees 19 times. I mean, we played them. A couple times we've played them already, right? In early April, they were the second one, and then we have them coming up later in May, and then we see them for 4 games in July. I think we might be. I'm looking at the schedule now. Oh, July, the end of July, and there's 3 games at home. We are done with the Yankees by the end of July.
Wow!
Don't play them in August or September.
Interesting.
So it will be interesting. But
I haven't been recently. I haven't been this year at all to experience the new shortened game time.
That is a nice feature because it used to drive me crazy watching it. My grandfather always used to hate watching baseball games. He listened to them. When watching me, he used to listen on an old radio, transistor radio.
Yeah, my granddad too.
He loved doing it that way. Even when he could watch it on TV, he had a little train, like on the kitchen counter, he would listen to it and do his accounting work. I remember, and because if he watched it on TV, he'd scream at the TV and yell at guys to get in the batter's box. Right? They had to fix each glove 16 times, take their hat off. They step out every pitch. I love it.
Right.
It definitely is speeding things up, and it makes you pay attention, because what happens with those long breaks, you tend to get in a conversation and not pay attention to what's happening.
Right. And then you miss, right? So. Yeah. Well, so anyway, all right. Well, so speaking of sports, this week we're talking about a sport.
Is that a sport?
Kind of. Juggling, right? Juggling chainsaws.
Because it's a tricky thing we're talking about.
It is a little bit of a tricky thing. How to buy and sell a home at the same time.
There's all kinds of issues that you have to think about and think through if you're going to do that. Because people are, I think there's the people who are selling homes don't think their house will take long to sell their home.
Right.
But do they sell first and then buy? Because they'll sell their house so quickly, and then there might not be a house that they want to buy. So what do they do in that situation? Then if you go the other route and say, all right, I'm going to look for a home that I want and try and buy that, then list my house and hopefully sell it quickly. What if I don't sell it quickly and I have to close in that loan
all the
first?
things that go through people's heads.
So
well, that's the episode, folks. So thanks.
Well, we're going to give you answers to this.
Yeah, we are.
But we have a segment that we call the rundown that we go through first.
Yes. So, Michael,
yes, sir.
What do you got for us on the mortgage front?
I was kind of surprised this week. Now, this was for the week ending, where is it? Why can't I always find it? Oh, April 28th.
Yeah.
The week ending April 28th, last Friday, mortgage applications went down. The reason I was surprised is there was a slight drop in mortgage rates during the week last week, the week ending April 28th.
Yep.
And it had been the pattern that as rates dropped, applications would increase, and vice versa. As rates went up, we saw applications come down.
Right.
Good news is that it was a small decrease, only 1.2% on a seasonally adjusted basis, and on an unadjusted basis, it was 0.4%. Neither one's a big deal, so it's pretty steady there.
Yeah.
The good news is that year over year, applications are only down 51%. Now, that might seem like a huge amount, but if you've listened throughout the beginning of this podcast, which started in January for us, we were looking at 70 and 80% year over year reductions.
So we're making up a little ground.
Well, I think the year over year comparisons will get better.
Yeah.
But it is still, it's still indicative of a seller's market.
Strong seller's market.
There's not a ton of inventory out there. So if you want to buy, your best bet is to apply for a mortgage, get pre-approved, and go through some of the strategies mentioned in this podcast and previous ones about getting approved and making sure you have a strong application, or some of the ones we're going to give moving forward.
Yeah.
Now, when it comes to interest rates, we are recording this a little bit later than we normally do. Usually do it on a Saturday.
Right.
Luckily, I have the advantage. We're doing it on a Wednesday because I said I was away.
Yep.
And I have the advantage of the Federal Reserve meeting concluding. No surprise there, they raised rates 0.25%. Now, they don't raise mortgage rates. They do an overnight lending rate called the federal funds rate between banks.
Right.
An overnight lending rate between banks called the federal funds rate. They raised that 0.25%. These rate hikes are meant to slow economic activity, lending activity, and bring inflation down.
So first time we're over 5%.
5.25. Last time it was this high.
2007, right?
2006. Yeah, 2007. They raised it to this level. It took 11 months. Last time they raised this level, I think, was September of 2006. By August of 2007, they were cutting rates, and they cut pretty drastically because we had the great financial crisis or the subprime crisis at those times. We're not going to have that happen now.
Different world.
Yes. So looking forward, so they raised rates. It didn't affect mortgage rates. It's more about what they say in their forward guidance.
Yeah.
They're highly attentive, is the exact words, to inflation risks. Mm-hmm. What they'd like to see is wage inflation come down a little bit. I think we're going to have the advantage of rent inflation start showing up in some of the inflation data.
Yeah.
If wage inflation can come down a little bit, wage expectations will come down a little bit, and that'll help the inflation rate. We had an ADP report, another jobs report, which isn't the non-farms payroll from the government that comes out this Friday, showed that the headline number had a lot more jobs created.
Yeah.
The good news was, and bonds actually rallied despite the headline beat, that year-over-year wages had come down from 7% increase to 6.7%. That's what the Fed's looking for.
Yep.
Last jobs report came out last month, showed a greater headline number than expected. I wouldn't be surprised if the same thing happens, but we also saw people joining the workforce, which helps bring down wages or the wage increases. If you have more people applying for jobs, there's less openings. The jobs opening and labor turnover survey showed that, the JOLTS report.
Right.
Less job openings, less wage pressure, less inflation down the road. It's not about what's happening now, it's about what's down the road and an expectation. So I think Friday's jobs report will show a greater than expected headline number, but will show continued improvement in the wage growth part of inflation that the Fed's worried about, and that we'll see a slight improvement in mortgage rates in the coming week.
All right, then. That's encouraging news.
Well, we'll see.
Yeah.
I mean, it could go the other way, and I'd be wrong, but
Well, it could.
that's my reading of the tea leaves.
Right. All right. Well, let me roll into the real estate market. So we're looking at the Baltimore metro area, Baltimore City and all the surrounding counties for the week ending the 29th. So we go Saturday to Saturday when we report our 7 days. So it's an increase in active listings of 3.57%. That's normal during this time of year. And in fact, I would hope that we'd start to see that tick up even more. We definitely need it to. But any kind of increase is appreciated. The pending listings dropped 4.36%. Settled, however, went up significantly. So that's an increase of 31.35%.
Isn't that a monthly thing? That was the end of last week of the month. That's
Yeah.
when people tend to close.
Yep. So the properties that went off the market, really no major change there. That's an increase of 2.07%. Really minor. Days on the market ticking down, the average down 12% from 31 to 27, but the median stayed the same, six days on the market.
It could be that's a deep time of year thing. A lot of people are interested to be buying.
People are out in droves. The volume went up pretty nicely from 250,194,000 and change up to 309,539,000 and change. That's up 23.72%. Number of concessions went up actually a pretty decent amount. That's a 30% increase, a little over 30%. The percent getting the concessions, though, went down slightly. So, but half a point. The average dollar amount of concessions went up about 4.5%. So a little bit more back to the buyers. That's always helpful.
Yeah, well, that's why I was wondering when the volume went up, if the average went up. That makes sense.
Yeah.
Although we did see a slight increase in those getting.
Yeah. So. All right. So the average list to sold price ratio. Let's just talk about excluding auctions, because we know auctions skew the numbers. We've been hovering at about 99 to almost 100% for a couple of weeks now. And last week was 99.88%. This week, 101.96.
I was going to say, have you ever gone over 100%? I can't remember you saying it, but I imagine there is. And even excluding auctions makes sense. I mean, guess
more buyers are paying over the list price.
The houses that are top of the line are getting escalation clause, appraisal gaps, addendums.
Yep, absolutely.
I have 2 of the 3 loans I have processed, 2 of them have appraisal gaps.
Yeah.
So.
All right. Anyway, median sales price. Last week we were at 360. We're up to 377.5 this week, so an increase of 4.86%. And as we've been seeing, it's bouncing up and down a little bit, but we're in that range, and we've been in that range for a little while now, so not really a significant change. So that's your 7 days. That's the mortgage rate changes and mortgage application activity. Michael, when we come back,
yes, sir,
we're going to get into the
I'm excited.
the scoop, and we're going to be talking about juggling chainsaws.
I like this. This is a good topic because I've got a lot of real world experience.
Yeah. So, juggling chainsaws, how to buy and sell a home at the same time. We'll be back in just a sec.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, sitting with my good friend,
Michael Becker of Sierra Pacific Mortgage. I'm standing up just because I wanted you to be incorrect. What if I was standing, Brad?
Well, then I could have said that.
Yeah, standing
across from
but
me.
you're standing across from me.
Yeah.
That would have been funny.
But anyway. All right, so Michael, we're rolling into the scoop. We're talking about juggling chainsaws, how to buy and sell a home at the same time.
Never used to be an issue.
In a normal market, it's a manageable process.
From my standpoint, the hardest point was if you were a loan officer and you knew you were handling the purchase of a property, doing a loan on it, and the people selling the home were closing that same day.
Right.
And if there was some unforeseen hiccup that was slowing things down, scrambling to get, because it can cause all kinds of issues. In a normal market, a lot of times people would buy and sell, and they'd close the sale of their old home and the purchase of their new home
Same
on the
day.
same day.
Yep.
If you delay the closing, then guess
It's
what?
the 10-car pileup.
Because the people who are selling to your clients, they're buying another house too. You're messing up that purchase.
Right, and those people were selling, and so they're going to get affected too. It's just this whole daisy chain. Yeah.
If it can be because of that, it's nice if you can arrange that. And things, if you have a long settlement time, over 30 days, there should be no issues. Even when a hiccup comes, to close on time. And in a normal market, it's nice. Let's sell and close at the same time.
It's still possible to do it today.
Scary though.
It is. It's tougher.
It's tougher because of inventory limitations.
Mm-hmm.
You sold your house. Your house probably will sell quickly.
Yeah.
Now, the people buying the house, if they're flexible about when they can close or potentially renting it, letting you rent it back from them,
Yep.
makes it a little bit easier. But it's tougher now because you were saying you had somebody who wrote 15 offers before they got one accepted.
That was a while. That was at the peak of our mania back in
I've had similar
2021.
but
right?
it's not easy to get the first. So when you sell your house and it's under contract to sell to buy the next house, you better hope there's something there that you like that you want to buy.
Yep. And
And
then
that
you've
you
got to
get
be
the offer
ready. You
acceptance.
got to be ready. You got to commit to the offer. You got to commit to the strategy. Lately, you and I were talking about this on the break. I've had very good success with buyers listening to me about what's going on in the market,
help.
with what's happening, and they've listened. We've structured the offer competitively, and we've won. And so those buyers, they've written one offer and gotten their offer accepted, and I have to remind them, what you just experienced
It's not normal these days. It
it's
used
the
to be.
extreme exception. Yeah.
So I think a good way to go through this is let's start from a normal market standpoint, or the traditional way of buying and selling houses simultaneously.
Yep.
That you list your house first,
Yep.
then you go buy a house second and talk about the challenge that presents. And then if people out there are concerned, because I've heard some people from agents, you and other agents as well, that they have buyers, but they're afraid to list their house because they don't think they'll find anything
That's
to
a
buy.
big point, right? Everybody's worried about
But
that.
we have a strategy.
Where am I going to go? Yeah.
We have potential strategies that
Sure.
many people might have not thought of that they can use to handle that. The reason the second version's harder, that is buying a house before you sell your existing one,
Right.
is financing, right?
Yeah.
Because
Yeah.
generally speaking, people take most, if not all, of the proceeds from the sale of their existing home.
To jump it right into the new home.
Put it in, it covers the down payment, closing costs, everything like that. In
Right.
fact, there's one of the things, source of down payment.
Mm-hmm.
There's several listed in the Uniform Residential Loan Application. Equity from existing property.
Right.
And that's most often used. So if you don't have that, if you're going to buy a new house before you sell your existing, you have a couple issues.
Yeah.
One, debt to income ratio. Two, assets. We'll get to that. Let's start. What do you think? Let's start with the normal way.
Yeah. So in the normal world, and we haven't seen normal for a couple of years now.
It may come back.
It could be. Yeah. I hope. I pray that it does.
But we could do the normal with some changes.
Yeah,
close to the
we'll
market.
tweak it a little.
Yeah.
Yeah. All right. But yeah, in a normal world, there's ample inventory. We have a more balanced market. Remember, folks, we've been in a situation where our inventory has been 1 month or sub 1 month for quite a while now.
Right.
And 6 months is considered balanced. So when it's lower like that,
I mean, I think 3 months would be like a great improvement.
3 months would be beautiful. That would, and nationally, we're getting closer to 3 months.
Is that right?
But here,
No.
here in Baltimore metro area, we're still right around a month, and so it's still extremely tight
For
inventory.
you to ask people
Yeah.
a year ago today, when because rates started rising and they got pretty high. They got pretty high in the spring, in May or so, and then dropped really low in August, and then started high until they hit the high in October. So, a year, let's say 6 to 12 months ago.
Yeah.
If you ask people, given the raise in interest rates, and rates will be here in middle of 2023
Right.
at this level where they are now, would there be an inventory? Most people would say, no, demand will drop drastically.
Yeah,
and we
absolutely.
wouldn't have
It'll
an
drop off a cliff,
And
and
it
it really hasn't.
So,
Yeah.
anyway.
Yeah.
So we have that issue.
Yes.
People, so let's say
But
somebody
let's-
decides they're going to move.
Yeah.
They're going to move mostly. A lot of times when you're selling and buying a house, it's two reasons: it's downsizing or upsizing,
Right. Right.
One-
Or relocation.
or relocate. Well, relocation you're going to have to sell before
You've got to. Yes.
You got to do it.
Yeah.
So it's one of those. It's a change of lifestyle. Your family's expanding, or it's shrinking because you're becoming empty nesters, and the house is just too big to care for, maintain. You don't
Right.
need it anymore.
Right.
You need something that suits your lifestyle a little bit.
Yep.
So you go to sell, you list the house, and you're under contract, right?
Yeah. Yeah. All right. So most times in a normal market, you're listing, but you're also kind of searching at the same time, right? You're just not super aggressive about it.
You're kind of looking. You're
Yeah,
testing
you're
the
just kind of
waters.
dipping the toes in the waters. But you're still looking. But there's plenty out there to look at in a normal market. So nowadays it's like we said, it's much more challenging. But in a normal market, yeah, you have much more inventory available. You have options. You don't have to jump the moment a house lists to jump and go see it and write the offer that day and
Yeah,
and
if
then
you're window shopping while you're getting your house ready to list, the likelihood of any of those homes you're interested still being available
slim to none.
by the time you get your house listed and under contract.
Right,
are.
right. And it's funny, we get buyers nowadays who say to us, "Hey, I want to start looking, but I also need to sell. But can you start sending me listings?" And I'm like, "Well, we can. Just I want you to realize that if you're not ready to move on this, don't get attached to any single property." And I tell them about that up front because it's the worst thing in the world. Well, it's not the worst thing in the world, but it's terrible to get emotionally invested in something that you see online and you think, oh, this is the one, this is the perfect house for us, and then you're not ready. So anyway, all right, so let's back up. You're listing and you're searching around the same time. The process that you'd follow, number one, you got to get your finances in order, right? You've got to understand, and Michael, you alluded to the financing options that you can consider. You've got to talk to a good local lender and have that conversation and understand what you have the capability of doing. And if you can, if you can afford, if you can qualify to purchase before you sell, well, that's great. But most people don't have that luxury.
A lot of people have issues with doing that, so that's why they're forced to do that. So now you have to look at the financing issue. You're looking at, all right, what am I going to net? What I come across when people are selling a house and looking to buy a new house, more times than not, is an inflated number they think they're going to walk with.
Yeah.
From the sale of their existing house.
Sure, and that can be because they believe their house is going to sell for much higher than it will, or they believe that, they forgot, as a seller, you do have some closing costs involved. Plus, you have to pay your fees for your listing, and so there are costs.
There's repairs to be made. You have to cover the listing and buyer's agents' commissions.
Yep.
And in the state of Maryland, most purchase contracts are split. Recordation and transfer taxes are split
50-50 usually,
between.
right?
So, anywhere from 6.5% to 9%. I always tell people just count on 7% because in this market you don't have to spend a lot on repairs,
right,
to get a house because people won't be picky because you just drop
nowadays, especially.
Right.
Yeah.
So thinking about netting 93% or 7% is what it's going to cost to sell the house. So start from that aspect, especially the people who can't qualify carrying both loans. Like if you're moving up and you're buying a more expensive home, and considering that interest rates are a little bit higher, so that housing expense is going to be a little greater. So it's pretty good to nail in what you think you're going to be financing. Am I going to have 20% down?
Yeah.
Am I going to have 25% down? What's my interest rate going to be? If I don't have 20% down, what's my mortgage insurance going to be? And really take a reasonable look at what an insurance cost, homeowner's insurance is going to cost. Don't, if some loan officer out there gives you numbers for a house that's $700,000 and they
like
give you $50 a month,
like your client, you
$50.
You saw that estimate recently. That was
I brought that point up. I thought
that was pretty crazy.
Because debt ratios are very important. It's sometimes going from 45 to 47% debt to income ratio is the difference between being approved and not being approved.
Yeah.
So,
absolutely.
If that's the case, if you're looking at a super tight debt ratio because of higher rates and a higher purchase price because you're moving up in home,
Yep.
perhaps a smart thing to do would be look at getting rid of other debt that has a higher monthly payment that goes into your debt ratio and putting less down on the new house. Let's say you have a car that's got 15 payments left, but it's $500 or $600. Getting rid of that $6,000 or $7,000 might save you $500 a month on your debt ratio.
And it probably save you on the loan level price adjustments too, because you're putting less down. Well, we'll talk about that.
That's a topic for next week's.
It is. Yeah.
Next week's segment.
Yeah.
We wanted to talk about it this week. We'll talk about it next week. But anyway, that's what do you mean by getting your finances. There's a lot of variables out there. It's tougher if you're going to buy a house before you sell existing. But even selling a home, given where interest rates are, where your housing payment is now,
and what it's going to become.
A lot of people that are in the move-up buyers, there are some of them out there. Some people are sitting tight, but some people just want to move forward and get the idea that this market's not going to get any looser in the near future because demand is so strong,
right?
And inventory is going to be limited for a while. That get your financing and figure it out. Be pretty smart about it. And from the financing guy's standpoint, I need all your data, not only what you make, where your assets are, all your assets, what you can conceivably come up with. If for a short period of time you might need a gift from a family member, even though you're selling a house, that needs to be considered as well because that can help. Every bit of your whole finance. I'm not prying. I'm just trying to get a grasp of your overall financial picture to be able to advise you pros and cons of
and it's better to know that up front too, because you don't want to get down the road and then discover something and then be hugely disappointed because what you dreamt of you can't follow through with. So,
I had a client I was advising who bought a house for $450 in 2020. Thankfully, it's going up to almost $600,000 in value.
Yeah.
He's going to walk with some equity, but rates are a lot higher, and he is looking to buy in the $700,000 to $800,000 range.
Mm-hmm.
And that presented some issues with down payment to avoid mortgage insurance, to avoid being approved or not approved. And he just gave me bank statements. He had some other assets that, if needed, because he was selling a house. If you don't get top dollar for some reason for this, you have to have a backup plan. What are you going to do?
Yeah.
Buy the next house?
Yeah. Okay. So get your finances in order. Step number one. Then you got to sit down with a realtor and you got to discuss your options. You got to create a plan. You got to understand how we're going to handle this whole process. And there, you can list first and then get it sold and then try to find the property. That's kind of the normal market. That would happen all the time. Start your search and list at the same time. You might even start your search now because inventory is so low, and keep looking and keep looking and keep looking while you're getting your house ready to list. You just can't necessarily write an offer that will be contingent on the sale of that property, because that's going to be tough to get accepted. But we'll get to that in a little bit. Anyway, so you got to understand what the plan's going to be. It's going to vary depending on the seller, soon-to-be buyer, based on their financial situation, based on what's going on in the market, based on the available inventory. All of those things are going to factor in to the plan that we develop. So don't assume that if you listen to one podcast, you've got all the answers for what you're going to do and what, this is my approach. It's going to vary. based on your circumstances.
Well, not only does it vary, but having backup plans or multiple plans. You have a plan of action, but having backup plans should this happen. Like you just recently mentioned, maybe selling a house and going under. You're going to sell your house, but you want to buy a house with a contingency. On the sale of your house. What if you find the house and they love everything about your offer, except the contingency?
Right.
Then you're scrambling.
Can you try to remove that contingency?
Believe me,
and it's a risk.
I get a lot of those calls on weekends, and it's not something I can generally. If clients give me every bit of data that I need, sometimes I can remove it that weekend.
Yeah.
But if not, I'm a little cautious giving a pre-approval that's not contingent on the sale of existing house if there's debt ratio and asset issues.
Yeah, absolutely. All right. So once you've met with the realtor, you're also going to start getting your home ready for sale. And we talked about this in episode 9. We had a whole episode on preparing your home for sale. So go back and listen to that. It was great content. But you want this house to show well because you don't want it lagging on the market for a long time. So if you have to buy and sell at the same time, that's a really important thing to remember. You can't have that property hanging out there. You've got to do what you can to make that house shine so that it stands out. It's ready, move-in ready for somebody because you're going to need it to sell quickly.
Has to show well, and, am I getting in front of this? Well, no, you don't have it in there, or it has to be listed at the right price.
Well, that's also very true.
Part of that plan.
That's all part of the plan, right?
Because if you think you're going to get aggressive with the listings up front and then it sits there and you're forced to cut, that'll probably mean your listing will languish more than it would otherwise.
Yep. Better to come out of the gate with the right price for the property, for the market, not be aggressive on the pricing.
That's part of your planning. You're getting your finances in order to feel, all right, if we sell it for this, we'll net this. What does this look like for the purchase of a new house?
Right.
If it goes higher, what does that look for the purchase
and we're not
of a new house?
We're not looking to leave money on the table. That's never the goal. That's never the goal. So people, I think, may worry about what we just said and say, oh, you're telling me not to go higher on the price. There's a reason why you don't inflate the price. And that is because the buyer pool that is operating today is far more educated than they ever were. Zillow and the democratization of housing data is out there. Everybody knows if a property is overpriced and they let it sit, and that's exactly what you don't want to happen when you're trying to do both at the same time.
Good point. We're not trying to leave money on the table. We're trying to be realistic here.
Yes.
Some people get overly aggressive with the listing prices, and you said the data is out there, not only for the people who are looking to buy a house, but agents who are representing buyers have have even more data.
Yeah.
And if they've seen nothing that's sold in that neighborhood and
to support that, right?
That support that value, they might be willing to say, hey, yeah, it's not, it's probably a few thousand higher than anything else that's sold in the neighborhood, but that's the market these days.
Right.
That's okay. But if it's 50,000 over anything that's sold in the market and it doesn't have the salient features that
people are looking for,
that support that value,
Yep.
then it's stupid.
Yep, absolutely. All right. So anyway, then you're going to list your house for sale once it's ready to go. You'll come up with your down payment. Michael, you talked about some of the things with regard to that when you're talking about some of the financing options. And those sources, we can talk about that in a little bit.
When we get back, we're going to get back to the selling, buying before you sell. Right.
Yep.
Normally, your down payment is going to come from the sale of your existing home if you're doing them the same time or selling your house first.
Right. Yeah. Anyway, so then you start your search, right? And you start looking around at all the available properties for sale, and you see what's going on. And sometimes we can even try to create a market if the market doesn't exist. So right now people are worried about, there are just no homes to buy. Well, sometimes that's true, but it is getting better. But if you have certain neighborhoods that you love, we'll reach out to the homeowners in that neighborhood and try to create inventory for you as well. So that can be another approach. If you're worried about where you want to go, if you identify certain areas, we can certainly reach out and have that conversation with sellers, and that sometimes produces pretty good, favorable conditions for a reasonable conversation. Anyway, so if you get an offer first before you find the home of your choice, you want to negotiate the best possible terms, but the big thing then is you want to try to arrange for what they call a post-settlement occupancy period, or a rent back. It's also called a rent back. If you do that, you can have up to 60 days.
Why is
that? because if you go beyond 60 days, you really need a lease, and it's mortgage fraud. Beyond that, because you've said
it's considered an investment property.
it's
if you're buying a house in
it's
somebody's
then you're
renting.
and if you've said, oh, I'm buying this property as a homeowner, as an owner occupant, and then you don't live in it, then you're committing mortgage fraud.
The deed of trust has a note date on it, and
Yep.
it says you will occupy this property within 60 days
Yep.
of the note date.
Yep. So that's the maximum that you have. And that rent back, you're not creating a formal lease. It's just a license for the existing homeowner to live in that property beyond the settlement date
Now,
for
when
up
you-
to 60 days.
When you're negotiating that, let's say somebody gets an offer, right, and you haven't identified a property, so you're thinking about to your buyer, you're selling a house, and you say, hey, we might need a rent back. And do you start off with a long rent back period, or do you do a month, or can it be written in the contract where the rent back may change based on? I guess it can. I guess you got to decide what the date is, and then if you still haven't found a home when the rent back ends,
You got to
you're
find another
short-term
place.
housing, right?
Yeah. Because
Have you
you're
ever had
limited
it-
to the 60 days. So
Well, what if you
gotta
ever
get out.
had it that the person, let's say they find the house and they're ready to move, and the rent back, they don't need it for that time. I guess you could do an addendum to the contract and have it end sooner, couldn't you? Or
You
no?
could, yeah, theoretically. I mean, you could, if a seller leaves. I mean, you've set aside some money, and
Well, 'cause-
there may be some prorations that are necessary, but you could certainly have them leave
Well,
sooner
that's the
than they
point.
anticipated.
Often-
Sure.
Yeah, a rent back is generally taken care of at closing. It's a prorated per diem amount that's
Yep.
based on the borrower's new monthly payment.
Right.
Right.
And that also depends on whether
Oh,
if
yeah.
you're going to. Sometimes it's for nominal consideration, meaning there's no money that changes hands for that.
That's a way to sweeten your offer.
You can have a really strong offer if you say, "Hey, seller, you're welcome to stay in that house for up to 60 days at no cost to you." Now you're taking on some risk, you're taking on some expense, but that could be an attractive way of letting that seller stay in the property. So certain things to think about with regard to that. If you do that rent back, one of the things that we were talking about this again on the break, Michael, about if you do a rent back, great idea to have a nice umbrella policy on that home that you just purchased, because you own that home, and so if anything happens to that seller when they're in there, you're the homeowner. You could get sued theoretically for them falling on your property or something like that.
Correct.
So
That does pose some risks. So think about that.
so you manage the risks, but if the buyer isn't willing to do the rent back period for you, you may need to arrange for some short-term housing until you find.
Yeah, like
your
I told
next
you
home.
when I was a little kid and we sold our first house and our second house. This happens often with construction.
Yeah.
You sell your existing house and you're buying new construction, and there are construction delays.
Yeah.
So you
Constantly.
So sometimes you have to live with family, if that's
Right.
possible.
Or an apartment, or an
Or
Airbnb, or
And there are some, it's funny, I was walking the dog the other day, and Mindy and I ran into friends of hers who were renting right near where we live because the construction of their house was not completed as expected.
Yep. It happens all the time. All right, so that's if you get an offer first. If you find a property though before your house sells, if you have a kind of a seller's market like we have today, it's pretty unlikely you're going to be able to negotiate that contingent contract.
Again, it's worth repeating. In a normal
market, you could do that.
You were going to sell your house and you're going to buy a new house. You had no problem looking for a home.
Yep.
Because you knew that the seller of that home would be okay based on a contingency.
Because theirs was probably contingent on the sale of their home.
Everybody had contingencies.
Everybody had contingencies, and it still worked out. So hopefully we can get back to that point. Today, it's unlikely. People just are not accepting the contingent offers. If it's been sitting for a little while on the market, which usually
It's
means
just
it's
not as many
overpriced or there's
contingencies.
something going on, then maybe you've got a little bit more leverage, but it's unlikely that you're going to be able to do it today. Anyway, see if you can qualify to purchase that home on a non-contingent basis. And you've got to understand the risks of potentially holding two mortgages for a little while.
Not only the risks and the ability to qualify.
Yep.
There are some people who have the financial capacity
Yep.
to handle the under debt ratio, the existing mortgage, and the new mortgage.
Yep.
You have to include both those in your debt ratio to be approved, except in this case, if you are buying a new house. You're under contract to buy a house, and then the existing house that you have. This is a Fannie Mae rule. I'd have to look up FHA guidelines, but anyway, if on a conventional loan you were going to buy a house, you're buying a house and it's not contingent on there. So you look your debt ratios to cover it. If they can't cover it, you can eliminate the existing house from your debt ratio, as long as you have it under contract and all finance contingencies have been cleared, and you're going to close within, I believe it's 30 or 60 days. I have to look that up. So you can take that out of your debt ratio, but you can't. I wouldn't be moving forward with that as the case.
Right.
So if you can't hold two mortgages, then you're running into trouble. All right, I got to come up with more income to do this. Well, how do you do that? Well, the only other way I could think of, because all loans allow what's called a non-occupant co-borrow. Even if you're middle-aged, if you had a parent who had decent income, right, and they have no debts,
have them sign as a non-occupant co-borrower.
Have them and help
if they're willing to do it.
Especially in this market. So right now, if you're buying a house, you're probably going to refinance. If they helped you get that house, it's going to be a short-term deal.
Yeah,
and
as long as your existing house is in good shape, you're pretty confident it's going to sell fairly quickly in this market.
Right. So you might not even need that non-occupant co-borrow when it comes down to it.
Right. So and if your house is already paid off, you don't have to worry about holding the two mortgages. You're just paying, taxes and insurance. That can be much more manageable. So it's all going to depend on the individual borrower's situation. But typically, you see if you can purchase non-contingent. Now, once you sell that home, then there's this idea of, okay, you've purchased that home as a non-contingent buyer, you finally sell your home, you can take the proceeds of that home in some loans and apply them to the new loan and do what's called a recasting.
It's specific to lenders, but most lenders will allow you to do what's called a recast. Now, I'm
not
not sure
not just lenders, right? Loan types too. I don't think there's some loan types like the Govy back loans. Can you recast them? I don't think you can.
You probably wouldn't. You probably,
it's
but you could do a
streamline.
Well, if you had to do a Govy loan, first let me say that recasting was a much bigger issue when this strategy of buying a home before you're selling existing occurred when rates were at all-time lows, because there was so much demand for homes and people stopped or slowed down taking contingent offers a year and a half, 2 years ago.
Right.
So when rates were all-time lows, a lot of people were looking to buy a new house, but couldn't wait to sell their own. So I get over the debt-to-income ratio. We also have to talk about down payment and closing cost money, but if you were buying a house at a super low rate, even if it had mortgage insurance on it, you could conceivably recast the loan. So this is how it works. You must pay at least $50,000 towards the principal.
Yep.
You generally have to pay a recasting fee of $500, maybe $1,000.
Not a ton of money, but some.
You would then the lender would recast the loan based on existing amortization. So let's say you had $356. The remaining loan, the new balance would be amortized over the new loan balance in the remaining term.
Yeah.
Which what that would do
lowers your payments.
Would lower your payment. Now, some people who like paying off their loan quickly, I'd say, or you could just leave it alone, and all of a sudden, when you throw a big chunk of change at the
you're paying the principal down so much.
It's a 20-year loan, or maybe a 15-year loan.
Right.
If you pay a lot of the principal down.
Yeah.
So there is that. If you do a small down payment loan, private mortgage insurance doesn't go away. It doesn't automatically drop off till you get 78% loan to value based on the original value and the original amortization. However, if you attempt this recast, you can request that it be removed based on the loan to value calculated at today's appraised value and the amount of the loan. The lender or loan servicer may request an appraisal to verify that value, but you can get that MI dropped. It doesn't have to be as long as you thought. So those two things would improve your situation.
Yeah.
These days, recasting is not such a big thing because rates are at the higher end of where they've been over the last 10 or 15 years.
Yeah.
So most people who are buying or getting a loan these days will probably refinance. If that's the case, you could always wait until it's time to refinance, throw that extra money towards the loan. Or you could throw it at the mortgage right away once you sell your house.
Yep.
Keep making those payments, you're paying the principal down, and then when the time comes to do a refinance, You do a refinance, the balance is a lot lower, and you might look at doing a 20 or 15 year note at that point when you refinance.
Fair enough.
All right.
Good. All right, so that was if you're in a seller's market. If you're in a buyer's market, and it's been a while, maybe one day we'll get back to that. You're going to negotiate the purchase contingent on the sale of your home. Like we said, that it used to happen all the time, and hopefully we get back to that time at some point. But then you can see if you can purchase non-contingent if you can. But the other thing you'll do is you might negotiate a settlement date farther out. Like if you're a buyer, you've got a little more leverage. You can say to the seller, well, I want to close 45 or 60 days out versus the, everybody now who wants, I want the, settlement to be 30 days.
You'll do a 21, 23 day, 25 day settlement.
Just to be super competitive.
To help your
Yeah.
be more.
Yeah. But in a buyer's market, you might have more leverage, so you might be able to push it back a little bit farther out. Anyway, once you get all that stuff worked out, then the big thing is you want to try to coordinate those settlement dates, because if you're trying to do this at the same time, you want to get them so that the dates coincide if possible, so that you settle on the sale of your home earlier in the day, and then you get the purchase later in the day. And if they can't happen for whatever reason, just try to arrange some sort of short-term housing, brief hotel stay, or whatever, and then the mover will store your stuff for a couple of days or a day or two or whatever that is. But you try to get them to coincide with the same date. And we still do it. It still happens in this market, even though it's a little tougher, but it is possible. Again, a lot of this stuff is going to depend on individual situations, but that's why you sit down and you talk with somebody who's experienced with this, because then we can help you out and understand what's going to be possible. Anyway, so some general advice on the idea of doing the settlements at the same time. If you're buying new construction, you mentioned that earlier, Michael, you may not have to list for a little while. If you're not settling on the new construction until the end, you've got a little while, so you don't need the money right away.
It could be 6 months before, by the time
six months or more, even if it's build time. So try to time that listing in cooperation with your builder so that you can close on the sale and purchase at the same time. It may not be the exact same day, but it can coincide much better. And depending on the builder, you may actually be required to close on the land first and then complete settlement when the home is finished. So again, it's going to depend on the specific situation that you're dealing with, but that's why you work with someone who is experienced and understands how to deal with those things. When you're working with the movers, I would find out what they're going to charge for a brief storage period, should that become necessary.
Definitely worth looking at.
Right? You plan for it to be at the same day, but if for some reason that doesn't happen, or if one of the settlements gets held up, or both of the settlements gets held up for a little bit, what are they going to charge you for that? All right, when you're packing, just keep a couple of days. I mean, this is, we're getting into some things that aren't necessarily related to the money, but they're part of that whole process of buying and selling at the same time. When you're packing, try to keep a few days of clothing and some important or the urgent materials stuff that you need separate from everything that you got back boxed up. So that way you have it, you have access to that, and keep that with you on your, in your person, in your car, whatever, rather than packed on the truck. That way you have it available to you so that you can have access to those things that you'll need more quickly. And then on the day of the move, in the morning, you get the stuff on the van. Then you go to the settlement for the sale, like we said. Then a little bit later in the day, you go to the settlement for the purchase of the home, and then you head to the new place. And that's the general stuff.
Yeah,
then but then you got to think about how do you make all the money work, right?
So that's a great point. One thing this is talking about buying before you sell.
Yeah.
We've mentioned the debt-to-income ratio and having the financial capacity income-wise to carry two mortgages.
Yeah.
The other thing is most people take the money from the sale of their home and put it down on the new home. If you do not have that money, how are you going to come up? I mean, you can do minimal down payments. There are, FHA 3.5% and conventional. Well, conventional, did you know that? You might not know this, but to put as little as 3% down,
Yeah.
at least one borrower has to be a first-time home buyer.
Yeah.
So if you've both been on a home before, and
You can't
have to
get
do at least
5%. Yeah, at least 5. Yep.
So, but 5%, like a lot of we're talking about. This might be a lot of people who are looking to move up rather than move down, right?
Yeah.
Move up buyers. If you're looking at a $500,000 or $600,000 or $700,000 house, 5% is a lot of money.
Yeah.
And then another 3.5%, at that level, probably 3.5% for closing costs.
Right. Sure.
So do the math. If it's 8.5%. And you're looking at 500,000, that's over 40 grand. If it's 600,000, you're looking at 50 grand. A lot of people don't have that money sitting around
right
in a savings account. So what do you do? First thing I'd ask, does your existing home have a home equity line of credit on it?
Yeah.
If it does, piece of cake.
Yeah.
Especially if that home HELOC's been open for a while and has the value open on it.
Mm-hmm.
Just borrow that money. You can use borrowed money for down payment and closing costs. Borrowed money, for the guidelines are concerned, you can borrow money for down payment and closing costs, but it must be secured against an asset. Meaning you can't do a cash advance on a credit card. You can't borrow it from family members.
Yeah.
Things like that.
Right.
So, but if you're borrowing, if it's leaned against the property and you're buying it, then it's fine. Personal loans would not be an acceptable source of down payment if it's not leaned against some property. If it's so those are the things. So
right.
HELOC's a great idea. I'd rather you do use that because you're going to sell that house eventually and then pay off that
HELOC too.
That HELOC.
Right.
If you have this savings, because I like, I'd touch savings if I had to, but I always like having a rainy day account.
Absolutely.
Never know when you're going to need it.
Don't hit your emergency funds
if you have to. But if you have excess savings, or you're somebody weird like me who likes to have 12 or 24 months of payments saved, you could do that.
Yeah.
There are things called bridge loans. Not every lender has them. It's usually your small local lender that'll have them. They have high costs and high interest rates.
Yeah.
So the HELOC, that's why the HELOC
idea is that it's a shorter span.
Right.
So.
Right.
Yeah. But
now there are other investments and other strategies that are scary that I've utilized in the past, and I'm going to mention them here, but please, as I say this, talk to your financial advisor prior
absolutely
to doing them.
And if you need a good financial advisor, let us know. We got it.
But there are people who are, if you're over 59 and a half, you can pull it out of a retirement account. You'd have to pay the income taxes on it if you did, but if it's you could pull it out, and if you sell your existing home. Let's say you pull it out the day before closing on your house. You're buying a house before you sell your existing.
Yeah.
You pull money out of a retirement account, and you use it to buy that house.
Right.
Your house is listed. All of a sudden, it gets under contract, or it's under contract, but it won't be sold before you close on the house.
Right.
You could put that money back into a retirement account. Let's say from a 401k, it's called a rollover. You have 60 days to put it back into account. You only do one of these once a year.
Yep.
And confirm with your financial advisor that what I'm saying is the truth.
Yep.
I've utilized this a couple times in the past where people have done this. It's a way to buy the new home.
Yeah.
If you're under 59 and a half and you can still do the rollover, you don't put it back in, you not only have to pay taxes, you're going to have to pay an 10% early withdrawal.
And let me just tell a quick story about the whole rollover idea. So I had the buyer on a house, and those sellers, they chose that approach. So there's some risk associated with it if your house isn't in great shape. We had a buyer who had home inspections, and the deal completely fell apart because the sellers had they had some major issues with their roof, and they didn't realize that they had major issues with their roof, but they had some major issues with their roof, and the deal completely fell apart. Well, so that house had to go back on the market, had to try to get a new buyer, had to try to get under contract. So that period of time that you have, you better make sure that it's likely that
it's a great point. Things can come out. I had friends of mine who bought on the Eastern Shore selling their house up here, and it was taking longer to sell up here. This was 2016, 15, 16, in that range.
Yeah, when we had crazy. Like 30, 45, 60 days was common.
And they were good friends of mine, and I was, they were using that money, and I said, look, if it comes down to, ask your friend's family if they can give you that money short-term, temporary, because you do not want to pay the early penalty withdrawal.
Right.
So it is a very risky thing. I'd like to use this more in an instance when somebody is closing on the purchase of a new house and they're under contract for their existing house.
Right.
And it's you've gotten.
Look, things are
commitment
looking
letter.
good.
Things
Right.
are looking good.
Yeah.
It is scary, but it's been done in the past, and you certainly can do it. Another way to get those funds, if you don't want to go that route,
Yeah.
all loans these days allow gifts. You can get gifts from relatives.
Yeah.
They can certainly gift you money for the down payment and closing costs. A lot of people get hung up on the annual exclusion. You're limited to, I think it's 17. It used to be 16, 17. It might even be 18 now.
Right.
Per person. So two people, your parents could give two kids $17,000 each for a total of $68,000.
Right.
If you go gift above that level, the gifters have to follow the gift. There's still a lifetime exclusion. It's over $5 million. It might be $11 million, but it used to be over $5 million. It's a huge amount.
Right.
But they'd have to file a gift tax return.
Right.
Again, talk to your financial advisors and your accountants on those.
Right.
But those are some possibilities. It's not impossible. If you have the capacity to carry both debt ratios and you're going to buy a new house, then you got to figure it out. And it's not always easy. Some people have the assets and it's no big deal.
Yeah.
Others don't. It can be a little trickier than you expect.
Yep. All right. So the last thing that I'll mention is just when you're going through this process, have a backup plan. And we talked about it a little bit before, but things can happen. Things can go awry. Have a backup plan. Ideally, you're settling on the same day, but have a fallback if for some reason something happens. You don't want to be caught off guard and unprepared for that situation to happen. So, look around. See what options you might have. If you need to have short-term housing available, just have that in your back pocket, ready to go in case you need it. And hopefully you don't. But anyway, all right. So Michael,
yes, sir.
Super great information. Thank you so much. We're gonna come back in just a second with the Unreal and the Spotlight, and we're gonna talk about some crazy things going on with some banks.
Yeah.
So we'll be back in just a sec.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster. Joining me is
Michael Becker of Sierra Pacific Mortgage.
Hey, Michael.
Yes, sir. It's the Unreal.
It's the Unreal.
That's so unreal.
Yeah, so I sent you this article from the Basis Points, one of the sources that we use, common sources that we use for crazy things that are going on in the industry. And
Or just get ideas. Yeah, they have a whole mortgage financing section.
Yeah,
Exactly.
and so there was a good article in here about how much in deposits did the 15 biggest regional banks lose from fourth quarter of 2022 to the first quarter of 2023.
Well, the one that jumps out at you is
First Republic.
And what happened to them over the week?
Yeah,
they didn't fail. They were taken over.
They were taken over by Chase.
We thought it was going to be PNC, but it looks like
I was
Chase
hoping
won.
actually that it would be PNC.
It seemed like more sense another regional bank because these big banks are getting bigger all the time.
Bigger and bigger and bigger.
They used to be called too big to fail. Now they're systemically important banks, and if something bad were to happen, who's keeping an eye on? I don't know. Who's keeping an eye on Chase to make sure they're not?
Right.
I always had an issue with Jamie Dimon. He was probably right because back in the subprime crisis started, he said we should have cut those mortgage brokers off sooner. Me putting the blame on them for the subprime loans, and it was, wait a minute, you guys came up with the product. We didn't sell anything that you didn't. You created it.
You created the product, right?
So,
yeah.
Anyway, that always bothered me.
Yeah, it's kind of funny.
And he's still to this day. Gosh, he's been ahead of Chase for a long, long time.
Yeah, yeah. Well, so First Republic lost $101.96 billion in deposits.
Is there any wonder they need to be taken over because their deposit base gets so low?
Yeah.
They don't have enough. Their ratios are too low, and somebody with deeper pockets has to take them over.
Yeah, and that was on deposits of 176 billion. So they went down to 74.47 billion in between Q4 and Q1. Now the next highest one, Charles Schwab. Charles Schwab lost 41 billion on deposits of 366 that brought him down to 325. After that, yes, there's some flight going on, but
I wonder
they're
how
noise
much
in comparison.
So what this chart doesn't say. So obviously the First Republic jumps out at you.
Yeah.
And then Schwab is big, but even though it's 41 to their 100 billion, their deposit base was started much higher. They lost 1/9. So what's that, 11%? Whereas First Republic lost 60-70% of their deposit base.
Yeah.
It's still concerning, especially since Jamie Dimon, the one who took the bank that took over First Republic, said this is it. Probably won't be any more. Well, right away, as soon as you hear that from any official, know that this isn't the end of it.
Yep.
There's probably going to be there are other issues out there. So who knows I don't think it's going to be a big. Get back to my point. Are these withdrawals? So some of these had withdrawals. They're not huge, but there's a good bit. And I wonder if it's people pulling money out in excess of the $250,000 FDIC deposit insurance.
Right.
Like if you have 400,000, why not spread that amount instead of having 4 or 5 or 800,000 at one bank?
Just spread it
Amongst different banks
so that you can have an insured balance.
It's insured.
Yeah.
Exactly right. So anyway, but one thing that jumped at you pointed out, there were other issues. A lot of people blamed. So the banks that went under, there was talk that they had assets on their books that they bought because the Fed encouraged them to buy it because they said rates would be low for longer, i.e. Treasury bonds and mortgage-backed securities. They bought all these because they thought Fed said rates were going to be low for a real long time, so there was no risk that these assets would drop in value. Well, they've dropped in value, and you're sitting on unrealized losses.
Yep.
And those losses become realized when you have to sell assets because you're losing so many deposits.
Yeah, right.
Apparently, First Republic jumbo mortgages contributed to collapse. I'm going to read a little nugget I got. It's First Republic's strategy of providing jumbo loans or jumbo mortgages to affluent individuals in Silicon Valley partly contributed to its collapse. The bank gained a reputation for operating interest-only mortgages. We know how that worked out in the subprime crisis at incredibly low rates to borrowers with high incomes and exceptional credit scores. They perhaps thought that the high incomes and the exceptional credit would offset the risk involved.
Yeah.
But typically, most people, on an interest only, you don't have to start repaying the principal balance for a decade. So what happens, let's say you provided a jumbo loan to somebody.
Right.
They bought in Silicon Valley or some of those West Coast areas that we talked about that had a huge run-up in values.
Yeah.
Small down payment, interest-only loan. You've never paid the principal down on anything.
Yep.
Strategic defaults.
Yeah.
I'm not saying that would happen. What I think happened is that the value of these mortgages dropped because of the drop in value, because of the riskiness, because they're interest only. Yeah. So some of those, they may have taken some losses. They might have had some realized losses that contributed to people not trusting their money in First Republic and pulling it out.
Right.
So that's the unreal, folks.
Yeah.
It's interesting.
Just do your due diligence.
Yes.
Yeah.
Yes. Yeah. Well, most of us don't have an issue of having over $250,000
That's
in savings.
also true. Right.
So,
yeah.
But I think the point being is it wasn't people fleeing the bank only that caused it. There were some maybe bad decisions by management on all cases of banks that have failed or have been taken over so far.
And there is some concern that the regional banking crisis may not be over.
Well, that's the point. There was the Fed President Robert Kaplan, a former Fed president of Dallas Fed. He suggested that the Fed pause this time. I mentioned earlier in his podcast that they raised. He called it a hawkish pause. He said, let's see what damage we've done to these regional banks by raising rates and having these assets they have on their book have unrealized losses.
Right.
Let's pause. They didn't because they're really concerned about inflation.
Yep.
And the Fed will, if you've invested in treasuries and mortgage-backed securities, will lend you money at face value to cover some shortfalls for a short period, for up to a year.
Right.
There's a lending facility from the Fed for that. But anyway, let's just stay tuned.
Yeah.
I don't think this was the last takeover of a bank, or maybe a last bank failure, but maybe there'll be some more takeovers in the coming weeks and months. We will see. The longer rates stay higher, the more stress it will put on some of these banks.
Yeah, absolutely. Absolutely. All right. So that's the Unreal, folks. Moving into the Spotlight. This week, we're spotlighting the fairly newly reopened Oregon Grill.
Oh.
So the Oregon Grill.
Atlas Restaurant Group took it over.
Yeah, they took it over, right? So it's been around for a long time, right? It's been a landmark restaurant. They're right at the gateway to horse country. They've been there forever. Iconic place. They're at 1201 Shawan Road in Hunt Valley, and they completely renovated it. It's a 19th century farmhouse. If you've ever been there, it's a 19th century farmhouse. Beautiful building. But they've completely renovated Atlas, the inside, and have done just a phenomenal job. So beautiful. They've got hand-cut steaks and seafood, and then just the little dusting of pasta, maybe, if you're so inclined. But if you're going there, usually you're going for steaks or seafood, something like that. Their food is just out of this world, and the service is to match. So it's great. They also have live music a couple of times a week. They've got Sunday brunch, 11 a.m. to 2:30 p.m. on Sundays, and then dinner from 4 to 10. And then the rest of the week, they have lunch from 11:30 to 2:30, and then dinner 4 to 11. And the bar stays open until 1 a.m. So,
oh, wow.
Yeah, great restaurant. They're on Instagram, by the way, at The Oregon Grill with an E on the end, Grille. And on Facebook, just search for The Oregon Grill.
Is Facebook a new...
Facebook, yeah.
That's competition. Is that Beaker?
Yeah, it was Beaker. Anyway, or you can find them at www.theoregongrill, again with the E on the end, .com, or call them 410-771-0505. But if you haven't been, find that special occasion, go check them out. It's definitely an experience you won't forget. All right, so Michael.
Yes, sir.
Great episode 16 in the books. When we come back next week, we're going to be talking about planning your move. And we're going to have a guest joining us. One of I think, the area's best moving companies. They just do a phenomenal job. And I'm really looking forward to having him come on. Moving is a complex process, and he's going to talk about his top insider moving tips. Okay. So stay tuned for that. If you want to listen to us, check us out on the web, BeRealPod.com. You can listen right on the site. You can also submit comments or feedback. Love to hear from you, what you think, what you want us to talk about. Tell us how you think we're doing. Ask us questions. And you can also listen on any of the major podcast platforms. So check us out. And Michael.
Yes, sir.
If somebody needs to reach you to talk about a mortgage, how do they get in touch?
Or any of these strategies you mentioned today.
Or any of these strategies.
Best way is my cell phone, 443-310-0012. Again, that's 443-310-0012. Call or text. I'll be happy to get back to you as quickly as possible. If you prefer the email, that would be michael.becker@spmc.com.
Great. Thanks, Michael. And if you need to reach me to talk about your real estate plans, you can reach me at 410-375-7550 or via email at brad@homesbyvesta.com. Folks, thanks for listening. Don't forget to tune in next week for Planning Your Move, Top Insider Moving Tips. Michael, thank you as always for another great episode. And we will see you all, talk to you all next week on Be Real,
the Maryland Real Estate Podcast.
Thanks, folks. Take care. Bye.
Try